Welcome back, everybody, for another deep dive. Today, we're tackling something that's often overlooked, but just as crucial for investing success as picking the right stocks.
Definitely.
The art of selling. And we've got some fascinating material from William J. O'Neill to guide us.
Oh, O'Neill's great.
Yeah, he doesn't just tell you what to do, but really dives into the why behind it all.
Right.
So we'll be exploring his insights on when to take profits, when to cut losses, and how to keep those emotions in check, which, let's face it, can be pretty tough in the heat of the moment.
Oh, absolutely.
Okay.
Especially when you see a stock climbing and you think maybe it'll just keep going up forever.
Exactly. That's the fear of missing out, the classic FOMO.
Yep. And then there's the flip side, the greed factor that makes you hold on way too long, hoping for just a little more profit.
Oh, I've been there. Remember that renewable energy craze a few years back? I was so convinced it was the future that I ignored all the warning signs. Well, let's just say those gains vanished faster than you can say solar panel. So that's exactly the kind of scenario O'Neill helps you avoid. He provides a framework for making those tough selling decisions based on logic and strategy, not just gut feeling.
Yeah, one of his most well-known strategies is the 20%, 25% profit-taking rule.
Okay, so you're telling me that even when a stock is still going strong, O'Neill recommends selling once it hits that 20 to 25% gain.
That's the idea. Now, this might seem counterintuitive, especially in a market that's gotten so fast-paced.
Right, because what if it keeps climbing after I sell?
It might, but O'Neill's research showed that a lot of stocks, especially those with rapid growth, tend to peak around that range before pulling back. So it's about locking in those gains while you're ahead.
So it's like taking some chips off the table when you're winning at poker, right? You don't want to risk losing it all by getting greedy.
Exactly. And the beauty of this rule is it frees up capital that you can then reinvest in other promising opportunities.
Oh, that makes sense. So let's say I sell some of my tech stock that's up 20%. I could then use that money to jump on board the electric vehicle trend that's just starting to gain momentum.
That's the idea. You're essentially rotating your portfolio, moving money from stocks that are peaking to stocks that are just starting to heat up.
This is really resonating with me because honestly, I always struggle with that feeling of what if I'm leaving money on the table by selling too soon?
I hear you. But O'Neill helps you shift that perspective. He makes you realize that every decision to hold a stock is also a decision not to invest in something else.
Right. So it's about recognizing that there are always new opportunities in the market and you need to be ready to seize them.
That's the key. And to help you identify those opportunities, O'Neill provides a bunch of tools and indicators to spot when a stock is strong, but also when it might be getting ready to correct.
Okay, give me an example.
Sure, he looks at things like price momentum. Is the stock continuing to make higher highs and higher lows? He also looks at volume trends. Is there strong buying volume supporting the price increase?
Okay, so those are things I can actually look at on a stock chart, right?
Absolutely. Even if you're not a chart wizard, you can start to recognize these basic patterns.
Got it. But let's go back to that 20%, 25% rule for a second. Can you give me a real-world example of how this actually plays out?
Sure. Let's look at the software as a service sector between 2020 and 2023. Some of those companies saw their stock prices go through the roof.
Oh, yeah.
But if you bought in early and followed O'Neill's rule, you could have sold when they hit that 20–25% gain and pocketed a nice profit. And guess what?
What?
Many of those stocks went on to correct pretty significantly. So if you held on hoping for more, you would have actually ended up losing money.
Ouch. That's a tough lesson. But it definitely highlights the importance of selling high and not getting greedy.
Right. It's not about trying to squeeze out every last dollar.
Right.
It's about making smart, disciplined decisions that protect your capital.
I'm with you there. But what about the other side of the coin? What about knowing when to cut your losses?
That's where the 7%, 8% stop loss rule comes in. This is your safety net to prevent those small losses from snowballing into big ones.
Okay, stop losses. That's something I've always struggled with. It feels like admitting defeat.
I get it. Nobody likes to be wrong. But think of it this way. A stop loss isn't about admitting defeat. It's about managing risk. It's like having insurance on your car.
No, okay, I like that analogy.
You hope you never have to use it, but you're sure glad you have it when you do.
So how do you actually set up those stop losses without second-guessing yourself all the time? Like, what if I set it too tight and miss out on a rebound?
That's a valid concern.
Yeah.
The key is finding a balance that aligns with your risk tolerance.
Okay, so not too tight, not too loose.
Right. You don't want to be shaken out of a stock on every little dip, but you also don't want to ride it all the way down to it tanks.
So how do you find that sweet spot?
Well, one common approach is to set your stop loss just below a recent support level. These are price points where a stock has historically found buyers and bounced back.
Oh, interesting. So I'm not just picking a random number. I'm looking at the stocks chart and finding those key support levels.
Yes.
This is all starting to click for me now. It's like by setting those stop losses in advance, you're taking your emotions out of the equation. You're letting the system do the work for you.
Exactly. And it can be a huge relief, especially in those moments of panic or indecision.
Totally. So we've talked about profit-taking stop losses and how to keep those emotions in check. It's a lot to digest. What other gems does O'Neill have in store for us?
Oh, he's got a whole framework for identifying winning stocks known as Canslim, which ties directly into this selling approach. And we'll dive into that next.
All right, I'm ready for more Canslim magic.
Let's do it. All right, so we've covered some key strategies for protecting your profits and minimizing losses. But the big question is, how do you find those stocks that are actually worth selling at a profit in the first place?
Right, because you can't implement those strategies if you don't have any winners to begin with.
Exactly. And that's where O'Neill's famous Canslim system comes in.
Hmm.
It's like a roadmap for identifying companies with explosive growth potential.
Okay, Canslim, I've heard of it, but to be honest, it always seemed a bit intimidating, like something only Wall Street pros could use.
I get that. It's an acronym after all, but it's actually pretty straightforward once you break it down.
All right, I'm all ears. Give me the Canslim rundown. What am I looking for here?
Each letter stands for a specific factor that O'Neill identified as being common among top-performing stocks. So let's start with C, which stands for current quarterly earnings.
Earnings. Okay,
Yeah.
so we're talking about how much profit a company is making.
Right, and O'Neill wasn't just looking for any earnings. He wanted to see strong and accelerating growth. He wanted companies that were blowing past analysts' estimates and showing significant year-over-year increases.
So it's not just about profitability, it's about the trend of those profits. Are they going up? And are they going up at an increasing rate?
Exactly.
You got it.
All right, what about A?
A stands for annual earnings growth, because one good quarter doesn't tell the whole story. O'Neill wanted to see a consistent track record of strong earnings over several years. So it's about looking for that steady upward trend, not just a flash in the pan.
Precisely. He's looking for companies that were firing on all cylinders and showing sustained profitability.
Got it. So we've got strong current earnings and strong annual earnings. What's next?
This is where things get a little more interesting. N stands for New Products Management, or price highs.
Ooh, okay. So we're looking for companies that are doing something new.
Right. O'Neill believed that companies introducing innovative products or services, shaking things up with a dynamic new management team, or hitting new 52-week price highs were often poised for big moves.
I can see why those would be signs of a company that's breaking out from the pack.
Exactly. It's about finding companies that are disrupting their industries and attracting attention from investors.
So far, so good. What about says?
SAES stands for supply and demand. This is all about looking at the trading volume and the float, which is the number of shares available for trading.
Okay, so we're getting into the nitty-gritty of how the stock is actually trading.
Right. O'Neill wanted to see stocks with increasing volume on up days and decreasing volume on down days.
What does that tell you?
It suggests strong buying interest and that institutions are accumulating shares.
So it's not just about the price, it's also about who's buying and selling.
You got it.
Okay. I'm guessing that stands for something to do with leadership, right?
Spot on. L stands for leader, or laggard. O'Neill was all about investing in industry leaders, the companies that were dominating their respective sectors.
Because they're the ones most likely to continue outperforming.
Exactly. He believed they were more likely to deliver strong returns.
Makes sense. Okay, we're down to the last two letters. What does I stand for?
I stands for institutional sponsorship. This is about looking at who's investing in the stock.
Like the big players, the mutual funds, the hedge funds.
Right. O'Neill believed that if those institutions were buying into a company, it was a strong sign of confidence.
Because they have teams of analysts and tons of research, so if they're putting their money in, it must be a good bet.
That was his thinking.
Okay, last one.
M stands for market direction. This is a big one. O'Neill recognized that even the best stocks can struggle in a bear market.
Oh, yeah, it doesn't matter how good a company is if the whole market is tanking.
Exactly. He emphasized the importance of paying attention to the overall market trend.
So even if a stock checks all the other Canslim boxes, if the market is heading south, it's probably not a good time to buy.
Right. You don't want to fight the trend.
Makes sense. So this Canslim system, it's a lot more than just picking stocks that are doing well. It's about looking at the bigger picture, the overall market environment, the company's fundamentals, the trading patterns.
It's a comprehensive approach. And it's not just for finding stocks to buy.
Oh, you're right. It can also help you decide when to sell.
Exactly. If the stock starts to show weakness in one or more of these areas, it might be time to reconsider your position.
So it's not a set it and forget it kind of thing.
Mhm.
You need to constantly monitor your stocks and make sure they're still meeting those Canslim criteria.
Precisely. O'Neill was all about being an active and engaged investor, not just setting it and forgetting it.
This is really eye-opening, but with so many stocks to choose from, how do you even know where to begin your search?
Well, O'Neill recommended focusing on leading industries, the sectors that are showing strong growth and innovation.
Okay, so I'm looking for those pockets of the market that have the wind at their backs.
Exactly. And within those industries, you want to find the companies that are leading the charge, the innovators, the ones hitting new price highs.
All right, so I'm looking for the all-star players, the ones at the top of their game.
That's the idea.
But let's be real for a second. It's easy to get caught up in the excitement of finding new stocks and chasing those potential gains. How do you avoid making impulsive decisions?
Discipline is key.
Mhm.
O'Neill was a big believer in having a plan and sticking to it. That means setting those profit targets and stop losses in advance and resisting the urge to chase every hot stock tip,
It's like having those guardrails in place to keep you on track even when the market gets crazy.
right? And remember, those rules are there to protect you.
Okay, so I've got my plan. I'm staying disciplined. But what about those times when the market takes a downturn? How do you handle that?
Well, O'Neill was very clear on this. You don't fight the trend. If the market is in a downtrend, it's time to play defense. Protect your capital and wait for things to turn around.
So it's like knowing when to batten down the hatches and ride out the storm.
Exactly. And during those times, you can refine your watch list, do your research, and get ready to pounce when the market turns back in your favor.
I like that analogy. It's like you're a surfer waiting for the perfect wave.
That's a great way to put it.
This has been so helpful. I'm starting to really grasp the power of O'Neill's approach.
It's a game changer for sure.
But it's more than just picking stocks. It's
Yeah.
about having a system, a plan, and the discipline to execute it.
It's about taking control of your financial future.
Absolutely. Well said.